Cheers, thank you very much for that introduction. Well, obviously gold is flying, and I'm hoping those of you that have actually been investing throughout the cycle are feeling pretty buoyant at the moment. So other than the obligatory corporate slide, I want to keep this presentation focused on just four key things. Number one, we have grown to 1.8 million ounces in resources over 3 emerging hubs, and that is in the heart of the WA goldfields. We are drilling today, we do plan to continue drilling, and we plan on continuing to grow. Number two, when we do drill, we add ounces to our resource table pretty cheaply. So the new ounces that we've added have come in at a cost of $19 per ounce in exploration costs. 3, in June, we did release the pre-feasibility study at a $5,500 gold price, which is about where it is today. It's demonstrating a $2.3 billion net present value at an 8% discount rate. It's got an 8-month payback, and it's got an internal rate of return of 160%. We also produced a 1.1 million ounce reserve as part of that pre-feas. And finally, number 4, we are obviously working on the DFS. It's due in the June quarter of next year, and we want to move straight into construction and start pouring gold by December 2027. So corporately, as a reminder, we are in a pretty strong position. We've got $19 million cash as of the end of the June quarter. We've also got some options expiring end of October, and that's got the opportunity to bring in $6 million. So they're 14-cent oppies. If any of you guys own them, better start getting in the paperwork. Last year at this conference, we were trading at about 10 cents. We're close to double that today. Again, last year in this conference, we had 8% institutional ownership. We're up over 26% institutional today. And another important point is the last 7% growth in institutional ownership, that's actually happened on market. So even the instos aren't waiting for a capital raise to get on board. So corporately, strong position. The macro environment for gold is giving us some amazing tailwinds, and we are laying some really solid foundations to build what will be a multi-decade gold business. So just from a geography perspective, Mandilla and Spargoville, 70k south of Kalgoorlie. Our third project, Faysville, is only 14 kilometres south of Kal. It is the heart of the WA goldfields. The pre-feas, again, demonstrated this potential multi-decade mine, 95,000 ounces per annum for the first 12 years. The financials were strong at a 42.50 Aussie gold price. They are absolutely flying where we stand today with spot pricing. Last year, I would have spoken to you about the importance of location. With what is happening around the globe, you want to understand the jurisdiction that you're investing in, and certainly Western Australia is a pretty safe bet. Mandilla, we are located on reclaimed pastoral land that now vests in the Crown. We can't water any sheep or cattle with that water, nor can we irrigate crops, and we are not competing with anyone else from a land use perspective. The area is well regulated and it's low sovereign jurisdictional risk. So whilst it doesn't eliminate permitting risk, I can certainly say with 100% belief that our risks are minimal compared to our peers. Process plant, mine offices, workshops, heavy vehicle go bay, it's all located 500 metres off that Coolgardie-Esperance Highway. That is the freight corridor between the eastern states of Australia and Perth. Within that corridor, we've got potable water, we've got piped gas. We're located 25 k's from Kambalda, which has got fantastic facilities, a plus 300-man accommodation village, and an all-weather airstrip. And also importantly, every mining and maintenance contractor that you might want to use are located in Kalgoorlie, which is only an hour's drive from site. So location does matter, and our risk profile as a result of that location is lower, and which will help from a construction perspective and from an operating cost perspective. So here's the pre-feas that we published in June of this year, 95,000 ounces per annum, 12 years, 1.1 grams per tonne. And then for the next 6.5 years, we're actually treating low-grade stockpiles that we've built over that period, and that's producing 42,000 ounces per annum. So a 13.2-year mine life, and then we're processing for 18.5 years. So this is building towards a multi-decade operation. All-in sustaining costs, $2,100 Aussie, so lots of headroom there. Peak negative cash flow, 230 million, 180 million for the process plant, which includes obviously the plant, non-process infrastructure, tailing storage facility and contingency, so that's 180, and then another 47 million in pre-production mining to get that ore ready in front of the process plant. Simple, large-scale open pit, 5.5 to 1 strip ratio. Financials, incredibly robust at a $4,250 gold price, $1.4 billion net present value, again, using an 8% discount rate, 2.8 billion in free cash flow, 1 year payback, 100% internal rate of return. As I said before, if you're using the spot price today, that NPV jumps by $1 billion to 2.3 billion and the free cash flow jumps to 4.2 billion. So when you're pitching these sorts of stories as an MD, you're always told to avoid talking about any of the negatives. Don't touch on the risks. But the reality is project development is risky and you shouldn't discount that risk, because once you turn on those expenditure taps, if you don't actually get your revenue on time nor get it to the quantum you're expecting, then you can be in a world of hurt. Failure isn't going to be an option for us at Astral. So if we see a problem, we will cut a plan to fix it. If we see a risk, we will put in place actions to mitigate. And one of our risks early on was we did have a lack of tenure to develop Mandilla in the optimal way. So earlier this year, we completed an off-market takeover for Maximus Resources, and that has addressed that risk for us. The transaction has allowed us to ensure we minimise the distance that we haul our waste. So that will reduce our operating costs. You can see that design on the right of screen, that all of our waste dump is neatly wrapped around the open pit. It makes for a much lower cost operation. As part of that transaction, we got 139,000 ounces of pit-constrained resource and 144 square kilometres of tenure, which we are just recently finished drilling on. So this slide here just shows some of the recent results that we had. So we drilled 8,500 North. We drilled a number of other targets. It was a 12,000 metre program. I've only put out results on the first 30% of that program, but 11 metres at 1.2, another 26 metres at 2, that's all in the one hole, 20 metres at 1.4, another 30 metres, 13 metres at 1.2, and then 2 holes at 1.4 grams per tonne. The thing about that, there was a paleochannel deposit near surface, and now we're already pointing to a fresh rock resource. So it's early in our exploration effort, but we are confident of our ability to build a fresh rock mineral resource at 8,500 North, and as I said, I've still got another 8,000 metres of results to pull out of that program. This next slide is about resource growth. In April, we updated the Mandilla mineral resource estimate. Then in May, when we completed the transaction for Maximus, we restated our group resources and it grew to 1.8 million ounces. Again, that organic growth, $19 per ounce. Importantly, when we released the pre-feasibility, we demonstrated that we were able to convert 95% of the Mandilla resources and 86% of the Feysville resources into our production target. So that conversion rate from resource to production target, quasi-reserve, is incredibly high. So what I want you to take away from this slide is when we put out results like the slide I just put up, you need to have faith that as we convert that into an Astral resource, that Astral resource will convert into a very profitable mining ounce that we can truck into our Mandilla process plant. So I'll just touch on Mandilla, which is the flagship deposit, for a couple of slides. Big deposit hosted within a granite intrusion, regional structure, the Karramindie Shear. Where you get a deflection in that shear is where the resources have lobbed. Thea, Hestia, Eos and Iris, 4 deposits there. With the recent transaction, we've got the Wattle Dam gold mine immediately to our east. That was the highest grade gold mine in Australia from 2010 to 2013. And then 22 kilometres, that's immediately to our west. 22 kilometres to the east, you've got the St Ives gold camp, which is 22 million ounces now. So this region is prolific for gold, and in our mind, it's actually inconceivable that we are not going to continue to find ounces over time on this tenure. Here is Thea in long projection. We updated those resources, as I said, in May of this year, but prior to that we drilled 4 diamond holes. We hit these very high-grade structures within Thea. Those high-grade structures are probably likely that they introduce the mineralisation into the granite intrusion. 2.5 metres at 170 grams per tonne, 10 metres at 28 grams per tonne, 25 metres at 4 grams per tonne. We are currently doing a 10,000 metre program of infill at Thea, And then once that's complete, we've got a 3,000 metre diamond program where we're going to test those high-grade structures, both internal within the existing Thea deposit and also extensionally. With this 99-hole infill program, we put out the first results, so the first 17 holes on Wednesday of last week. So this program is only just beginning. We are drilling this on a 12 by 12 metre panel now to build confidence as we move towards production. And these early results are certainly indicating that the resource is living up to the model interpretations, and if anything, we've potentially got a little bit of upside to this resource. So of those first 17 holes, 32 metres at 11 grams per tonne, 2 metres at 96 grams per tonne, a metre at 20, another 34 metres at 1.6, 9 metres at 5.1, 17 metres at 2.2, another 16 metres at 2.3. So some very solid results within this infill program. Now finally on Thea, and I've said this countless times before, this is a 1.2 million ounce single open pit development in a region where finding these plus 1 million ounces is becoming exceedingly difficult to do. There is no single asset developer in our region that has the scale of opportunity that we have in front of us. Also, this deposit is the third largest in the region behind the Super Pit of Northern Star and their Red Hill deposit. So this is a very rare beast. So I'll just touch on exploration at Feysville for one slide. Feysville and Spargoville, these two deposits are all about us finding high-grade gold that we can displace some of the lower-grade feed from Mandilla early in the mine life to help drive the net present value, just really increase the value of this project. So this Feysville tenement package, 200,000 ounces at 1.2 grams per tonne. Last year in this room, I said we wanted to demonstrate that we could produce 100,000 ounces of gold from this tenement package in the pre-fees. We actually end up demonstrating 132,000 ounces of gold. The cash flow that this thing generates is very, very meaningful, and it certainly demonstrates the value you get from generating these satellite deposits and feeding them into a large-scale Mandilla process plant. With the RC drilling we are currently doing at Mandilla, when that finishes, we've got a 7,000 metre program here at Feysville where we're going to target Camperman and some of the regional projects. So looking ahead, we've just finished 20,000 metres of drilling across Feysville, Iris, Hestia and Spargoville, 10,000 metre program happening at Thea, another 3,000 metres of diamond to commence in October, and then a 7,000 metre program at Feysville. So our commitment to growth, you can see that commitment demonstrated just by the amount of metres that we're putting into the ground. We've appointed the DFS engineer. We'll be announcing that shortly. We're just finalising the actual contractual documentation with them. We're on track to announce a debt advisor. We've got some senior appointments that we're about to make. And all of this is working towards completing this DFS and moving into a final investment decision. Environmental submissions, we expect to put in the works approval in the December quarter, and we need to do one more spring survey, which is about to start now, for the Spargoville tenure. Native title agreement for Feysville, we expect to get signatures on that in the coming quarter, and our schedule here in terms of completing the DFS June quarter and then gold production 18 months after that, this is an aggressive schedule. Now to finish off, I'll just reiterate, we are well funded, the pre-fees we delivered on time and within guidance. We will deliver the DFS by the June quarter of 2026 and we are funded to achieve that outcome. We will continue to drill, we will continue to grow. As a team, we actually know what we need to do to progress this towards being fully permitted and fully funded. We've successfully achieved that outcome before. Our projects, they're in the Kalgoorlie goldfields. This is an infrastructure-rich region. It's got strong community and local government support. It's got a regulatory framework that we understand and we are comfortable trying to navigate. The project has conventional mining and very conventional processing. The pre-fees demonstrated that it produced $2.8 billion in free cash at a 42.50 Aussie gold price, and that jumps to $4.2 billion at today's price. So the pre-fees is certainly worth moving through into production. And this development timetable that we have, whilst it's aggressive, it's achievable, and it sees us at first gold in the December quarter of 2027. Thank you.